Good day, Guildenchain. What have you been up to?
Hello, Rose. I've been following the news about the COVID-19 coronavirus, and wondering about the probable economic impact. Do you think it's serious?
The virus? No idea, I'm not an epidemiologist.
Fair enough. Me neither. But I meant the likely impact on the global economy.
Right. I think it's totally serious. In fact, I think it's going to tip the world into the next Great Depression.
But that won't really be the fault of the coronavirus itself, will it? I mean, it's just a catalyst.
Of course. The virus will get blamed, but really the underlying systemic problems were already present. A century of horrible central bank monetary policy is the true cause.
We talked about some of that last time we met, how so-called stimulus is really just a hidden tax that transfers wealth up the pyramid to the elites.
I remember. Look, Gil, the fact is 2/3 of China has been idled for more than a month now. Even if the coronavirus disappears next week, you can't stop the motor of the world's second largest economy, largest consumer of petroleum, and largest supplier of intermediate goods to global supply chains, without serious knock-on effects. China is even the third largest export market for the United States. Today's globalized world relies on supply chains 5 or 6 levels deep, with just-in-time inventory. Plus all the world's big economies are brittle with leverage, financialization, and speculation.
And it's finally starting to sink in for the markets. The Dow in the US has had the biggest weekly drop since 2008, 4,000 points. And the flight to safety in bonds has driven the 10-year US Treasury rate to the lowest level in history.
Going back to the 1790s.
Uncertainty is leading to stock sell-offs, which creates a vicious spiral. $5 trillion just evaporated from global equities. Dip buying isn't working anymore.
Absolutely. And just like in 1929, we have overvaluation of both bonds and equities, plus escalating monetary inflation.
Quite. What's rightly been called the everything bubble.
Yes, a bubble of malinvestment created through interest rate suppression by central banks. Soon we'll see an avalanche of bankruptcies, closed factories, and severely restricted human interactions, leading to what could be the greatest slump since medieval times. The coronavirus looks set to pull the trigger on a global financial and economic collapse.
Last time, we also noted that the worse things get, the more stimulus they'll attempt. So you're expecting more of the same, but on steroids.
It's already starting, at least in the East. China is slashing rates, and the government of Hong Kong just announced they're giving $10,000 to every resident over the age of 18, about $1,300 in US dollars.
Oh my. Actual helicopter money.
For real, though I expect it'll be distributed on debit cards, or something.
But as we observed before, it won't work. Central banks can't print raw materials or supply chain components, any more than they can print antibodies. Their policy tools are not only impotent, they're malignant. All they've done is crush savers, wage earners, and productive investment, while inflating a massive bubble in financial assets. All this money is malinvested in ludicrous companies that can never make a profit, and loans to broke governments that can never repay them.
Agreed. It would be hysterical if it weren't so dismal. Even if a coordinated intervention by central banks to prop up the markets happened, all it would do is make investors go long, to avoid missing out on the lows, while cashing in their hedges. Then when the next down leg comes, which it will, they'll have no hedges left. So one would hope that they'll recognize the futility of it all, and just let the crash happen. After all, what do they owe the punters and hedge funders?
The Fed giveth and the Fed taketh away. But it sounds like you don't think they'll do that.
No. They may want to, they may even try to, but they'll find out the hard way that they just can't do it.
Why not? We already know they don't care about the 99% whose retirement funds are trapped in the market. Besides, they can scapegoat all the populist leaders, particularly that Donald Trump guy.
For sure, that must be really tempting. But the reason they can't just say, now it's time for austerity, is that the Fed and its fellow central banks have unwittingly welded the purchasing power of their currencies to the value of financial assets. If one collapses, so will the other.
Wow, Rose. Could you explain that, please?
Sure. In a normal credit cycle, savers fund investment which goes into future production. Unwinding malinvestment hurts the individual banks and private equity firms that made the bad choices. The capital gets transferred to better managers via bankruptcy, and life goes on.
If only things still worked that way.
Yes. In today's world, bank credit is mainly deployed for financial speculation, to maintain asset values, such as via share buybacks, to sustain government borrowing, and support financial intermediaries lending to consumers. Thanks to interest rate suppression, savings have disappeared. And today malinvestment is rarely unwound, due to the too-big-to-fail model. So, what the biggest speculators do is borrow euros or yen, where the rates are zero or even negative. Next, they buy US treasuries at a spread of around 1.5%, and pledge them as security for a line of credit, adding, say, 10 times leverage. Then they buy a portfolio of financial assets on margin and chase momentum.
Just how big is this kind of trading?
According to the Bank for International Settlements, there were $59.4 trillion in outstanding FX forwards and swaps, mainly involving US dollars, in late 2019. Foreigners own a combination of cash and US securities valued at about $24.8 trillion, and hedge funds are short euros and yen a further $4 or $5 trillion.
Unbelievable. That swap total is 2/3 of gross global product. And foreign buyers own more US assets than the whole GDP of the US.
Indeed. It's called leverage, mate. Now imagine what happens when the underlying real-world economy tanks, bigly.
Armageddon. Leverage in reverse.
Exactly. To stop it, the central banks would have to become the buyer of last resort of every kind of financial asset, not just sovereign bonds but also stocks, commodities, credit default swaps and other derivatives, perhaps even real estate. The entire investment world would sell out to them, and they'd pay for it all with printed money. The lucky sellers would inevitably try and spend their cash on something, anything. They wouldn't hold it because they know it's going to lose value.
Meanwhile, on Main Street, the real economy is shrinking. And when massively more money chases fewer goods and services, bingo as the Yanks say, instant hyperinflation.
Your cash becomes trash.
Sounds to me like attempting a bailout of a crashing financial system will destroy the purchasing power of the currency, probably of all fiat currencies.
So they won't try it, right? But let's look at what happens then. Because of their leverage, all those punters with trillions worth of swaps will be wiped out in an economic collapse. As soon as they realize the Fed won't save them, what will they do? They'll have to unwind it all. It's all one giant Minsky Moment margin call that will result in everything being sold. This will trigger an avalanche of dollar selling, measured in the trillions. The size of this carry trade has forced the Fed to add liquidity through the repo market since last September, but now it will flow in reverse. The dollar will be dumped and the other currencies like the euro and yen will be bid to the skies. The Fed will lose control of interest rates, and the 10-year US Treasury bond will start yielding 10% or more, leaving the Fed as the only real buyer of US Treasuries. That will ruin everyone who fled into bonds, thinking they were moving to safety.
But Rose, the US dollar is the world's trade currency, so everybody needs it anyway, especially for energy, while the US is forced to run huge trade deficits. I believe this is called Triffin's dilemma.
It is. But in the midst of an economic depression, less oil will be needed. With global trade stalled by the coronavirus and the ongoing trade war, less of everything. So what happens to those foreign-held dollars?
One way or another, I figure they'll get repatriated back to the USA.
Top of the class. So once again, what do we get? Hyperinflation. First in the US, then in other countries. The dollar's loss of purchasing power raises domestic living costs in the US. Soon, people will sell what's left of their investments just to pay bills.
So failing to act to support the markets destroys the currency also, just by a different route. If they try a bailout, they'll flood the world with printed money. If they don't try a bailout, the liquidated dollars will come back to roost in the US economy. Either way, hyperinflation occurs.
Like I said, the Fed welded the markets and the dollar together. So now when one crashes, so must the other.
Will other countries, like the UK and in the EU, be better off?
Not for long, I think. A rapid and vicious switch from suppressive control to a realistic pricing of government debt will bankrupt just about every government in the world. Besides, other central banks like the ECB keep most of their reserves in dollars. If the dollar collapses, so will their own currencies. I would guess the Chinese yuan will crash first, then the dollar, then the euro and yen and others. But we'll see. It could all happen quickly.
My head is spinning. It sounds like the only hope to preserve purchasing power would be to buy uncorrelated assets like precious metals and cryptocurrencies.
Right, that'll work. Although gold can also get sold early in a crash due to liquidations to meet margin calls. It did in 2008, then doubled later. But where is most of the world's gold?
In the form of London good delivery bars, inside bank vaults in major financial centers, like New York, London, and Zurich.
Gil, do you know what a bail-in is?
I do. That's where your bank fails and all the depositors get treated as creditors of the bank, and don't get all their money back. They get shares, or something.
If they're lucky. It could happen with gold in an ETF, too. So if you're going to buy gold or silver, you'd better have it in your personal possession. To a large extent, the same is true of cryptocurrencies. You need personal control over your wallet keys.
Do you think Bitcoin will go up to the moon?
Measured in hyperinflated fiat currencies, very possibly. But in actual purchasing power, perhaps not. I think Wall Street already has a pretty fair amount of control over the price of Bitcoin, and while it will certainly go up, it won't be permitted to go too crazy.
I do recall the ex-CFTC chairman boasting of how they popped the 2017 Bitcoin bubble by letting the market interact with it, simply by allowing Bitcoin futures markets to exist.
A nice euphemism for letting big money use naked shorts to manipulate the price down. Same thing they do with gold almost daily. As long as you have cash-settled futures and leverage, deep-pocket players can always create enough artificial supply to meet almost any physical demand. Before long, a good chunk of the world's bitcoins will be in cold wallets owned by financial firms. And that's all the physical they'll need to steer the price, just like they do with gold. They'll also be able to legally sell the same bitcoins to hundreds of different and allocated buyers, just like they do with gold bars. It works as long as very few holders ever demand their coins or bars, and their policies make that expensive, and very hard to do.
Gold and Bitcoin will hold their value though.
Of course, they just won't go up as sharply as gold bugs and Bitcoin maximalists would like them to.
Sounds like we need some leverage of our own.
Which brings us back to Lira. Ascension's Lira is a growth currency that pays you to hold it, and pays you to promote it. And due to its unique tiered supply model, it's likely to earn you multiples on your original purchase, all while retaining a fractional backing in Bitcoin.
It's so well thought out. You'd almost think the Ascension folks saw all this coming.
It's Ludwig von Mises' unavoidable crack-up boom. It's been predicted for years. One doesn't applaud a tenor for clearing his throat.
I suppose, but as a free market money, Lira seems so well positioned to serve as a lifeboat for everybody lucky enough to find it and smart enough to see it. It's about to get really real, out there.
Which is why we need to separate money and state, as soon as possible. We cannot allow the same miscreants who dressed the stage for this crisis, to engineer its proposed solutions.
Would you advise people to convert some of their assets into Lira as a hedge?
I never advise anyone to do anything. I just give them information, and let them figure it out for themselves.
Very wise. We certainly can't choose what's best for someone else better than they can. If you're listening and would like to learn more about Lira, please contact the person who sent you to this video.
If only governments understood your point about making choices for other people.
Yeah, if only. Well, thanks for the chat, Rosencoin.
Until next time, Guildenchain.